on and focus on Cosmo First. The weakness continued for the company in Q4 on a YOY basis. EBITDA margin contracted sharply. However, revenue saw a mild recovery sequentially and profits also surged on a quarter-on-quarter basis. To discuss this, what's the outlook for the packaging industry and the other verticals of the company, we have Pankaj Poddar, Group CEO of Cosmo First, joining us now. Mr. Poddar, good afternoon. Thank you so much for joining us. Well, there's a sequential recovery in the numbers this time around. You've also mentioned that there is an improvement in BOPP full margins in the month of March, and that could have continued in Q1 as well. How much is that improvement versus the bottom, and do you think these margins have bottomed out now?
We certainly see or expect an improvement in these margins as, quarter on quarter it passes through. Definitely the demand is much more bullish now, and there's no new supply which is going to hit the market in this year. So if you personally ask me, I do see that, the margins should improve in the coming year, though right now what had improved in March has stayed in April and May till now.
Mr. Poddar, would you be able to quantify the kind of improvement that you're expecting in margins, both for Q1 and for the rest of the year? Do you expect to see sequential improvement as well, Q2, Q3?
Yeah, so right now I would say from an EBITDA perspective, it has improved by 1.5%. Though, the margins in the market general are still low. If somebody is operating just a commodity business, then we are talking about hardly 3 to 4% EBITDA levels for commodity business. And for polyester, it is still at a loss level. So even if you see though there is an improvement, but these levels are also not too sustainable. And given that demand is much better now, ideally it should ramp up in next couple of quarters.
Okay. So you also indicated specialty margins per kilo witnessed marginal decline in FY24. How much was this decline? What led to this? And can you also give us the sense of that export uneven order that you got? Did it get transferred to FY25? What exactly happened here?
Yes, so in general, what we had seen is that margins were under pressure all across, especially in our semi-specialty category. But the good news is that US is recovering and getting back to earlier levels. Europe has already partially recovered. So what we definitely see is that our export margin should improve, our specialty margin should improve from here.
Okay, and that export order, that when you call it uneven, what does it exactly mean?
So actually one of our segments last full year was absolutely dry. Partly it was, because I would say that they had overstocked during COVID time, but also given that, our customers were not getting orders for it for recessionary pressures. But what we have seen in Q1 of this year is that segment has also come back. And that should also help us in some improvement in the margins in Q1 of this year.
Okay. So in specialty chemicals, you have master batches, you have adhesives and coating chemicals, out of which you expect master batches and adhesive to reach almost 7 to 8% of revenue separately. That's what you've mentioned. So what is it currently, and how much specialty chemicals are contributing to the overall revenues? Do you see it in the next 3 to 5 years, and will this be margin accretive?
So this year, specialty chemicals should be doing roughly 10% of our group turnover, 7 to 10%, depending on, how the film numbers and how the raw material costs are there. And the good thing is that in chemicals, we have got some very good breakthroughs in last couple of quarters. And we do expect that it should make 20% plus ROCE in the coming year. So overall, all the R&D efforts that we had been putting in last 2-3 years have started to pay off now. And there's a very healthy pipeline of products that should also up and hitting the market. So this year we expect the revenue should be somewhere in the range of specialty chemicals of 225 to 250 crores. And at the same time, the margin should also, the EBITDA margin should start hitting double-digit numbers.
Okay, all right. And this will largely be in the adhesives, coating chemicals and master batches. The overall revenue will be around 250 crore rupees. Okay, let's talk about your pet care business. What was the monthly GMV this time around? Will you see a better number this year versus last year? And is this the year when you break even and do that demerger that you've spoken about earlier?
So one thing that we have done is we have set up a new legal entity, Ziggly Ventures Private Limited. Obviously, we have not moved the business as yet. We are still looking for the right time. But as we had said that, within 3 to 4 years, we will be moving the business to Ziggly. So if not this year, more than likely next year, we will be putting this in a separate legal entity. As far as the GMV numbers, we have started touching around 4.5 crores. The good thing is that we are witnessing a same-store sales growth, and our entire focus this year would be to make sure that our same-store sales growth should at least grow 60-70% within this year. And we are also witnessing that with same-store sales growth, our losses numbers have started coming down. Obviously, the other piece, which is the online business, where till now we were trying to sell others' products, or we were operating like a marketplace. Now we have started launching our private labels, and therefore it should also start helping us in improving our online margins, where the focus will be more on selling private labels than selling other products where the margins are lesser. So we are seeing quarter-on-quarter growth in revenue numbers, and hopefully the losses should not go up with higher revenue, which was the trend in the past. Ideally, what we should see is a significant growth in revenue numbers again this year, and at the same time, the loss percentage should come down. I don't think so break-even is going to happen in this year or next 1 or 2 years. It is going to take some time unless we achieve a scale of more than 150-200 crores. The profit would not be so easy. But the best part is this industry is growing at 18 to 20%. So 3 to 4 years, this industry will become a much larger industry, and we are happy to see that we have entered the industry at the right time.
That's a lot of clarity. Thanks for that. Mr. Poddar, net debt currently stands at a little over 560 crore. How do you expect the number to trend over FY25? And any capex plans, or on the other hand, any debt reduction plans?
So this year, we already had a committed capex of roughly 300 to 350 crores, which will happen during the year. This year, it will still hover between 2 to 2.5 debt to EBITDA ratios. But assuming that the market does not change too much, I mean, if market corrects, then obviously this number would look lower. Having said that, we do not have too much of capex next year. I mean, we've hardly committed any large capex for the next year, and therefore we will start seeing a very significant reduction from FY26. But we are sitting at a very good position right now, and obviously in next 12 months, we have to start looking at what next beyond this, because right now we have not committed anything for FY26 or FY27.
Okay, all right. So we'll speak to you again when there's some clarity, because the market has been very volatile when it comes to the packaging films industry. But thank you so much, Mr. Poddar, for joining us as always and giving us details. So some recovery that has been seen in BOPP film margins, but we'll have to see whether that sustains or not. We'll slip into a short break. When we come back, we'll get